Tyler, here we are again doing another video about NextEra Energy Partners. And this time, maybe for good reason, as much as the news has mostly been bad. In recent months, the company did sell off an asset they said they've been planning to sell. It looks like the market mostly liked it, but I took a closer look and I don't think it's that great of a deal. It's not a big game changer that a lot of people have been looking for from the company. You ready to rehash what's going on with NextEra Energy Partners?
NextEra Energy Partners is the gift that keeps on giving. Like when we need to talk about it, oh, look, there's a press release. Let's go.
If you're a shareholder, it hasn't exactly been giving. It's been a bit of
No,
a taker. But we always love to have at least, if not a good story, an interesting story to talk about. And I'm a shareholder of the company. I have been with a small position for a while. Tyler, before we hash out exactly what NextEra Energy just announced and what it really means for the company, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that after watching this video. Okay, Tyler, let's go back in time a little bit. And how did we get here? What's going on with NextEra? Why does this asset sale matter? And why is it something that we're making this video about?
much of 2023 this year, we have seen the stock price of NextEra Energy Partners go down quite precipitously throughout the year. And as a result, because it is a dividend paying stock, its yield has gone up really extraordinarily high levels. So much so that I think a lot of people have been looking at it as this high yield opportunity once in a generation or buy the dip or a lot of things like that. But there's been reasons why this is happening. And we
Tyler,
have
you and I have been following companies in the energy space where you find a lot of these dividend stocks in the midstream space and that kind of stuff for a long time. And in our experience, when a company's dividend shoots up a lot because the stock price is falling, it's very rarely is it ever for a good reason, right?
Yeah, it rarely is ever, oh yeah, everybody's wrong. The market, Wall Street, they're all idiots. There's normally a reason. And the reason for NextEra Energy Partners just happened to be that as the corporate structure that it had as a yield co meant that it had to raise debt or equity to purchase projects or assets from its parent company, NextEra Energy. Now, when the yield on the stock gets too high, then you can't issue equity and you're wholly reliant on debt. And then if you take on too much debt, all of a sudden you're too levered and your creditors won't lend you any money anymore, and then you're stuck. And so,
Here's a near-term example of that. Just over the past 4 quarters, shares outstanding have gone up 8%. If we take that out over the past 5 years, it's increased its share count about 2/3. When your stock price drops, your cost of capital goes up, right? So
mhm,
that yield is effectively, that's your cost of capital. And they can't issue equity
yep,
anymore to economically do these deals. So that's where
yep.
we are.
Now we're here. Now, this was a business that was growing its dividend at 10, 12% annually. And when all of a sudden your ability to purchase assets that would pay the increasing payout, you can't buy those anymore, then all of a sudden you can't justify keep increasing your payout that much. And then we saw a press release later that said we're going to reduce our distribution guidance, saying they're going to go from 10 to 12%, they're going to go closer to 4 to 6% annually. And that's where we saw a huge stock drop a little while ago. It was the right idea. It was look, we can't realistically grow this fast in this sort of capital environment with our stock price this low and the price on debt today.
You
As
can see
Jason's
on the
showing,
screen the cliff. This was the day they made the announcement. And let's be honest, directionally, we knew things were getting harder, right? And every high yield dividend stock that used a lot of debt or equity issuance has seen their price fall. Their stock price has fallen because interest rates have gone up. So there's a little bit of fear. Investors are like, this is not going to be good. This is going to be an underperforming asset. I want to move on. And also a little bit of, you know what? I don't need to own equity anymore to get a good yield. I can get 5% in cash or short term treasuries. And then this is okay, yeah. So they're telling us that they're making this move, but they're still going to grow their dividend. We don't believe you. And that's essentially
yeah.
what happened.
So we started looking
Yeah.
at the company's debt, and it had a lot of very cheap convertible debt that was about to expire next year, all the way through 2026. So in the next 38 months, basically had to refinance 70% of its debt. And so we looked at it and said, that's a lot. It's going to have to free up some cash. It's going to have to refinance this. And when it does, all of that refinancing is going to cost more in interest payments, which therefore is going to strain the payments or the outgoing cash in this business. And we thought something has to happen. And this most recent press release was something. And Jason, take it off.
I'm going to pull it up on the screen and share it. First of all, we knew the company was going to do this, and that was selling off its natural gas distribution assets. We knew it was going to do that. I've been talking about this for a while. And from a couple perspectives, it made sense. It was a little bit of an oddball holding. It didn't really fit operationally with the other assets that NextEra Energy Partners owns, which is primarily wind and solar, right? That's been their core business. NextEra Energy, its parent company, they're not out there buying a bunch of natural gas pipelines and the transmissions lines. Again, it's outside of their core business. And the decision was made to move on some time ago. They're selling it to Kinder Morgan. Kinder Morgan probably knows a thing about natural gas pipelines, probably knows a thing about valuing natural gas pipelines. The deal works out to about 10x, 10 times EBITDA, which strikes me as certainly not selling it for a premium multiple, right? Probably fair value is probably the best way to think about it. But let's get to the nuts and the bolts. What they sold it for, a purchase price of $1.815 billion. So we'll call it $1.82 billion. All right. Now let's get down here to the bullet points. So what are they going to do? They're going to pay off $425 million in debt. That's project related debt tied to the Texas pipeline portfolio. So they're going to pay down $425 million in debt. Now they're going to complete the $1.1 billion buyout remaining under this, the NEP Renewables 2 CEPF. So a lot of people are seeing that and saying, oh, okay. So another 1.1 billion in debt. You'd be wrong. They're not. That's not the convertible debt that you see on their 10K. This is convertible equity. They have a lot of this kind of stuff. You go through NextEra Energy Partners, Tyler, you go through their financial reports, their annual reports, and they have lots of these sorts of vehicles. So they're going to pay that off. And then they're going to use the remaining proceeds you see right here to pay down a portion of the outstanding corporate revolver. Okay, so they're going to pay off this. So they're going to have $300 million left over that they'll use to pay down the revolver. Here's the problem. As part of preparing for this deal, they paid off the STX Midstream CEPF, and they're going to pay off part of NEP Renewables 2 in December, $180 million. So $482 million right here. So call it $580 million. What's $20 million between friends? So they're putting $580 million on their revolvers to pay off $425 million in debt and to have about $300 million remaining. So by my math, Tyler, is that right? Net everything out?
Net everything out. And the other thing to keep in mind too is when you sell off assets, those assets have a cash stream. And so you're left with a smaller cash stream remaining.
Funny you bring it up. The total 2023 calendar year adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization. And there's
and other adjustments.
Yeah, and other adjustments. $181 million. The bottom line is that's $181 million in annual adjusted EBITDA. The NextEra Energy Partners is no longer going to earn once the deal closes and these assets belong to Kinder Morgan. So all of that to say this, Tyler, that's material. It's going to lower their debt by round figures about 5%. They have $6.5 billion in total long-term debt. So it is a 5% reduction in debt. So that's not nothing. That's something, right? But it is not a meaningful reduction in debt. And it does not address the debts that are maturing the soonest, that are going to see the largest increase in interest expense. So it doesn't necessarily change the risk profile for NextEra Energy Partners' ability to support its dividend. That's the key to me.
Yeah, I came away with more or less the same conclusion as we mentioned in the prior video. There's this big load of convertible debt coming next year that has an interest rate of 0.75% because of convertible debts have strike prices, and if they don't convert, it becomes regular debt, and when it has to be refinanced, the actual chances of it having a 0.75% interest rate, very unlikely. You're going to have higher interest payments, lower cash coming in the door, and with a modest decline in overall debt, which, yes, that will reduce its interest payments, but I'm going to guess that $1.6 billion of refinanced debt is going to have higher interest rates than the 300 or 400 that you just paid off.
I'm not thinking about that dividend as being safe. I would say flip a coin, whether they have to cut it at this point, because you think about those interest expenses going up, probably going to cost them, again, depending on the rates they're able to get, between $300 and $400 million a year. You look out 3 years from now, assuming they aren't able to pay any off and they have to roll it all over. I think there's enough margin in there that their cash flows will be sufficient enough to service the debt and support the dividend. But I'm not banking on that. I'm entirely thinking about this as a risk reward opportunity. Anybody that's thinking about this as a dividend investment and a safe source of income, I think you're making a mistake. If you're willing to take on a little bit of risk, unlike my friend Tyler here, I think it's interesting right now. Tyler's shaking his head.
Listen, you're going to drive me to drinking.